Yo, what is going on? This is Juan, and today I'm going to be showing you guys how to draw your trend lines, alright? So first I want you guys to look at the indicators. Now, alright, now I know what it's like to be a beginner, you know, I've been a beginner before, and I've been trading for a couple years now, but when I was a beginner, all of this was extremely complicated to me, so I want to show you guys to the best of my ability of how to draw trend lines. So here we have Berkshire Hathaway, Berk B, and now the first thing I want you guys to look at are these orange lines. Now you guys are probably like, wait, what are those orange lines? So these orange lines, they are called pivot points. Pivot points are resistance and support levels that are drawn out automatically by the indicators. So if you guys go up to indicators, boom, and you go to search, now all you guys have to do is put P, and this is on TradingView, by the way. Every single platform will be different. So if you're using TD Ameritrade, if you're using something else, it's going to be different. So find pivot point standards on whichever platform you're using. So now that you have pivot point standards, boom, you're going to go up to here. You're going to go to the settings and inputs. It always comes with show historical points automatically. So I want you guys to take it off because this is just way too confusing for a bunch of beginners. So like look at this. Historical points. I want you guys just to take it off. So indicators. So we're going to go to pivot points, and we're going to get inputs and take historical points off. See, now it's nice and clean. And all of these lines are key levels. They're key levels where the stock had trouble breaking. So it looks a little confusing, it looks a little annoying or whatever, but trust me, once you learn how to use them, once you get more experience, these pivot points are going to help you so much because they do the job for you. So go ahead and add them into your own trading. So next we have this yellow line right here now. It's just a big yellow line, so you guys are probably like, what even is that? So this is a 200-day moving average. What does that mean? That's the average price in a 200-day period for that stock. And why it's important is because the 200-day moving average is a key indicator to big financial institutions of when it's time to buy. So I want you guys to use this as support and resistance. So it's my support and resistance depending where it is. So if Berk B breaks below, like here it faked out, low volume, I'll get into that in a second, but it faked down, boom, came down here, and then came right back up. And as you guys can see, the 200-day moving average, it was a perfect support level. And what did large financial institutions do when it came down below the 200-day moving average? They bought the shit out of it. Boom, they bought a bunch, boom, 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 boom. They bought it, brought it right back up, and now it's going to retest, and I guarantee you the same thing's going to happen. It's going to come down, if they're going to rebuy it, or it's going to come down to these levels, retest this strong support here, which has been building, retest it, and boom, the same thing's going to happen. They're going to buy, it's going to come right back up, all the way to all-time highs, all the way to this area. Now, that's not any investment advice, none of that. I'm just telling you guys what I think and how I use my indicators. Like, when Berkshire Hathaway's 200-day moving average, it goes below, now it's time to buy. For big financial institutions, I'm not saying you, I'm just saying big financial institutions, they use 200-day moving average to dictate their investments. Now, what's next? Next, let's look at the volume. So our volume is the amount of shares being bought or sold at any given time. Now, this is extremely important for you to add because it tells you the amount of buyers and sellers at any single point in time. The red ones means that there's more sellers, the green means there's more buyers. So we have the volume, and next is MACD. And also I want you guys to pay attention to the volume. Like right here, there was low volume, so it broke below the 200-day moving average, and it also broke, it tested this strong support here. It tested this strong support, but it broke below the 200-day moving average. So since there was low volume, I want you guys to look at the volume here, the amount of shares. Boom, there's low volume. What's it going to do? It's just going to bounce right back up because there's not enough people selling it enough to disrupt the previous low and break the previous low. There's no volume, it can't break. And it's just a rule that a stock won't break if there's no volume unless it's like crazy news or unless it's like being like manipulated. which that's a totally different topic. But so boom, it not enough volume, it came back up, and now that's why volume is important. Now before we even start charting any of that, you guys should just know that. It's just, I feel like it's just the fundamental, the basics. And the bottom one, this is optional, but let me explain it to you guys. So MACD, it basically shows you when buyers and sellers are in control depending on the situation. Like, let me give you guys an example here. Here, we can see that, but I want you guys to look closely at this. Look closely at how the lines cross, because that's what's going to tell you what it does. So, boom. So here we have buyers in control. As soon as the blue crosses over the orange, and now these colors will change depending on what your preference is. So for me, it's blue over orange. It crosses, buyers are in control. At this second, as soon as it crossed, buyers were in control. And then as soon as it crossed again, this is the key point. It crossed again, and now boom, what does it do? It sells off. The same thing happened. It sold off because now sellers are in control. People are shorting it. People are selling that stock in this point of time here, and it's a direct reflection here. And what happened as soon as the trend reversed, boom, here, this was a direct indication that the trend is reversing. Look, it crossed again. The blue over the orange, it showed that the buyers are in control. And what happened? It came right back up. Right back up to these levels above the 200-day moving average. Now that we have all the basics down, all these basics down, now we can start charting. All right, so here we go. So first we're going to look for the lowest point. So let's look at the lowest point. What's the lowest point? It's going to be 212.30, around that area. So we're going to put down one of these, boom. And now we're going to look at the highest point, and there's a lot of high points, but we're going to be looking at this one right here. This is a key point here. And we're going to and we will get into more advanced charting, but for now, this is all you need. If you're a beginner, honestly, this is all you need. We can get into ascending triangle, descending triangle, on channels, on inverse head and shoulders, on cup and handle, inverse cup and handle, bull flag, bear flag. We can get into all of that, but for right now, as a beginner, I don't want you guys to focus on any of that. Why? Because you're gonna get so confused. Like for me, it was so confusing. So I want you guys just to focus on just previous high, previous low. That's it. That's all you need. You don't need to go all crazy looking at freaking Batman symbols and stuff. Like all you truly need is the previous high, previous low as a beginner. If I gotta be honest, I made a ton of money. I'm not trying to show off, but I made a ton of money just shorting the stock when it breaks, just previous low and previous high, shorting it or buying puts as soon, like when it breaks here with volume. All you need is previous low, volume, and then you need a MACD to confirm it. That's it. Volume, MACD confirm the trend reversal, whatever. Boom, comes down. That's it. So that's a trick for beginners. But if you guys want to get a little bit more advanced, like if you don't think that's enough or whatever, we can get a little bit more advanced. So here we have a bear flag right here. So as you get more into charting, you're going to be able to recognize more trends. So here we see that it comes down. And here we're going to draw our trend line. So we're going to look the key point of this video, how to chart. So we're going to look at the previous low, and we're going to look at the previous highs right here. And boom, right there. That's a bear flag. Why is it a bear flag? Because it comes down. And now, of course, you should draw it at a bigger. The bigger the move, the bigger you draw the lines, the bigger the move is going to be. So, for instance, let's say we drew a big ass bull flag, big ass bear flag. The bigger the move is going to be. Like here, it's going to be a little move. Why? Because it's a little bear flag. But let's pull up a bear flag. Now I had it ready because I did some consultations with a couple of my members from my Discord server. But here we have a bear flag, and what do we see? We see the flag pull. We see the bearish flag come up, boom, and then what do we see? Boom, it comes back down. And what do we see on Berk B? We see the exact same thing. We see it coming down, and then we see this channel here, and then we see the next reversal coming down. Sorry about that, I got a couple notifications. But that is the main point of that. The main point is that we're gonna look for previous highs, previous lows, and the further you go back, like let's go back a little bit. Let's go back a little bit. The further you go back, the more you're gonna find some trends. So like here, like a beginner right here could have made bank right here. A beginner could have made bank here. Look, so we're gonna get this one. So trend line, if you use trend line, it's gonna be a little bit more difficult because it's gonna be hard to line it up perfectly straight. So if you're gonna be getting like a large straight line, I want you guys to use a horizontal ray, because horizontal ray, it is all flat, and it's from like where you put it all the way to like endlessly. So here we go. So we're gonna put it here and on the previous high. So previous high, and let's find some more. Let's find another one. Let's do. I want to give you guys two for example. You do this today's high and this low. Now, as a beginner, you could literally just do two flat lines of previous tops, previous lows, and then make bank off that. Like you don't need to make like a bear flag, all that stuff. Like of course that is amazing to do, but that's once you get more advanced. But you have to get used to it first. You have to get your feet in the water. You know, you have to go slowly, and as you slowly progress, you're going to be getting better. You're going to be recognizing bigger patterns, and that's when you're going to start making different type of money, because now you're going to be catching bigger moves. You're going to be catching more momentum. You're going to know what good better swings and stuff like that. But as in day trading for beginners, this is great. Previous low, previous high. It could be controversial, but to me, this is more than okay. So here we have previous low, previous high, and now we see the trend moving up. Boom, it moves up. It first is below the 200-day moving average, and then it bounces up. It wants to break it. It keeps getting rejected, and here, boom, they buy it out. And I want you guys to look at here. Here, look at the volume. So if we look at the volume here, watch how it just spikes like crazy. It just spikes like crazy. And look at the volume back here. It's super flat. Although it's moving up, there's not a ton of volume. And as soon as it reaches the previous high, this is the most important thing. Watch the previous high and watch the break here. Previous high, break. So here it rejected the first break. As you guys can see, it went up. Boom, not enough volume. A little bit of volume. Boom. So it came right back down. It was bouncing around this level. And then what happened as soon as there was a ton of volume on the upside? A ton of volume. Look at this one. Look at this candle. Boom. It breaks with volume. New highs. Boom, baby. All this is profit. All this. Boom, 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 boom. And here you would have had some pivot points. So you would have had a pivot point here. You would have had a pivot point there. So pivot points is where you can trim or take your profits. So this is the what? 4-point move, 3.3, 4-point move. That's a lot of profit right there. Day trade, perfect for beginners. And here we have a boom. It's like a bouncy ball kind of. So it goes here, it bounces off the top, comes back down off the bottom. The same exact thing, except here is different because here it gapped up, which I don't recommend that you trick. So a gap up is like when the next day where it opens up. That's the most simple way I can put it. I don't want to confuse you guys with any large terminology. I'm trying to make it as simple as I can. Here it gapped up. We see a gap up, and never trade within the first 15 minutes of the stock market. And I'm telling you guys this because it is so uncertain. You have to let the stock market choose a direction. But here it gapped up. Boom, it gapped up. So here, every candle is 5 minutes, 5, 10, 15 minutes. If here you would have drawn the previous low and the previous high, without drawing some complex, anything that's super complex, here you would have made some money as well. Here, so bouncy ball, up, down, test the previous high, and then what did it do here? A little bit more volume, it broke. Now this is a little bit more risky because the volume isn't there, so I wouldn't have taken this trade. But if you're crazy or something like that, like honestly, watch the volume. Always be watching that volume. If the volume isn't there, here the volume wasn't there. So it came up, and what happened? It just sold off. So the volume wasn't there. So it just came right back down to these levels where it kept bouncing like a basketball. This is a perfect fake out, not in a ball. Honestly, that's a perfect example of why you need volume. Honestly, I shouldn't have said if you're crazy or anything like that, but all right. That's a perfect example of no volume. So let's just circle the volume. No volume. Not enough volume. And these were higher volume spikes. We need the volume at these levels. Now there was some volume, so it was able to come up to a couple levels higher, but then it sold off. But we don't want any of this. This is way too risky for us. We would never take a trade with it not enough volume. I want you guys to always look at the previous high volume and have it match that volume in order for you to get in. Boom. Let's delete all these lines before it gets too confusing. So boom. So it comes back down in this area, and then it comes up. It follows the 200-day moving average. Now here we could put another one. Previous high. Now we're trading differently. So let's erase this one. Now we're at the previous high here. Previous low. Now we could even go lower, but the correct one, let's go lower. Boom. Now we're lower. And the exact same thing. It's gonna be a bouncy one. It's gonna bounce up, bounce down. In this area, within this area, and as soon as it tests, wait for that volume confirmation. Here there's some volume, but it still rejected. Boom, it was bouncing around. Now, another way to make sure that it broke a trend is by looking at the candles right after. So here, we're not sure if it broke it, but the way to make sure if it broke it is that if it breaks and holds above. So say right here it broke, boom, it broke. Now we're gonna wait 10-15 minutes to see if it breaks above. Now it did break above, so 1, 2, 3, 4, 25 minutes, it broke above. The first 3 candles, and we caught it here. The first 3 candles we wait, 15 minutes, it held above. Now what happens next? It holds above, so that means that it was a clean break. Although there was not a ton of volume, it was a clean break because it held 3 candles above. So it holds 3 candles above, so right here would be a good opportunity to go in for some calls. You go in for some calls, a quick scalp, nothing too crazy, a couple cent moves, and you make a little bit of profit. Now, that's all that I wanted to explain to you guys for right now. And as we move forward, I'll explain to you guys like more advanced charts. We can look at bear flags, ascending triangles, descending triangles, all that stuff. But I don't want to confuse you guys right now, and I feel like as beginners, you're already confused enough, especially trading options. So I feel like this is good enough for now, at least. So I hope you guys enjoy the video and have a productive rest of your day.